Okay, this is a video about statistical analysis. In this file, now named Read Stocks from Google and Fred, we get, I'm sorry to review, but we download all these stocks, okay? And then we, let me go to the contents page again, okay? And then we also download some commodity prices, some gas prices, and finally we download an index, a stock price index. Now, to make a new table of contents, you get this from the generic macro. I just press this button, it redoes it, it goes and makes a table of contents for the entire, for all of the sheets. And then it makes a hyperlink, and for the last, I'll get this one, the hyperlink also, when I did the macros, I made another hyperlink that takes you back here so we can kind of inspect all the stuff. Now, when we're going to do this statistical analysis, it's going to be on stock prices, and remember, these could be anything. So I have this general set of stock prices, and I'm going to have some stock prices on renewable energy companies as well. And we just read them in. And then I said, well, look, from this Fred. No, whoops, oh, no. From this Fred thing, Federal Reserve Economic Databases, FRED, that's what it means. We just need to get this little code, and we put it together, and we make a little loop that reads them all in, and we have all these international stock price indices. And there's another page with the US indices. And then we have commodity prices, the oil, gas, the price of oil, price of gas, but price of, if you've got an agriculture business, price of agriculture or whatever. And then we put all of these things together. We link them up, and we made this little checkbox automated thing so we can look at all of our analysis. And this is going to be how we make statistical analysis around this. And you notice what I kind of have here. This is Shell Oil, and I only have a checkbox on the U.S. stock price index. Okay, and so this is a classic beta. And this classic beta, we take the percent change in the stock price versus the percent change in the index, which is just basically the S&P index. And for Shell Oil, we get a beta of 1. Then I'm going to show you how you can transpose this and what this autocorrelation means, and go through a little more statistical analysis to see why we take the percent change and not the absolute number, why you take logs, blah, blah, blah. And then volatility, that's just the standard deviation of the percent change adjusted for a time factor. So you get it in terms of annual percent. So the volatility of U.S. stocks is 18%, at least over this time period. The volatility of Shell was 27%. What's left over is this. Now if we, let's try Exxon. And put the calculation on, and then we get a little bit lower beta. Exxon's volatility, I forgot what Shell's is this, and all of this. Now, instead of taking the, okay, how about we'll try BP. Not very interesting, the same sort of thing, the same sort of beta. It is kind of interesting that all of these stocks must move very closely together so they have the same beta. You can also see how they react to the oil price. And we just click on the oil price. And Now the regression is the oil against BP, and this beta for BP is 0.25. Let's look at the beta for Shell. The beta for Shell against oil is about 0.26. The beta for Exxon is about 1.18. Maybe they have more refining than upstream or something like that. Now, if we take the beta of Chesapeake Energy, is supposed to be the biggest gas producer of shale gas, we get this kind of beta of oil. And we have a much, much higher volatility, but you take away that volatility, and what's left over after you take away the oil price effect is much less. And what should really be the measure of risk? It's really hard to see. Okay, and then we can make a scatter plot of all of this and kind of have the same equation here. All right, now I want to show you, I want to walk through what all this business of transposing the beta and taking the percent change and how to actually compute the volatility. That's what I want to kind of show you. I'm going to introduce the subject a little bit. I want to show you in this video just, well, how you can use the true false or the offset function. I'm not sure. True false is much easier. Offset, I always think creating a dynamic range name for the offset is a pain, but once you do it, it's nice. And then we're going to show you, well, how do you test for autocorrelation? What really, I've got to step back. If you're looking at time series analysis, which so often you would do in finance, and even in economics, you know, heteroscedasticity and all these other adjustments that get made by these statistical packages, for me, they're okay, and sometimes they can have a little effect, but the autocorrelation is so extremely important. And there is so often presence in autocorrelation, and explaining autocorrelation allows you to explain why you take the percent changes and not the absolute amounts, and allows you to not make kind of silly mistakes in doing some basic statistical analysis. So number one, don't be afraid to make statistical analysis. Number two, use an autocorrelation adjustment. Number three, it doesn't work in statistical packages, so why don't you do it yourself anyway? And then I'm going to talk about the volatility. And when something is volatile on a day-by-day basis, can you imagine something like an electricity plant? Every day it's much higher during the day perhaps than during the middle of the night. Every single day. So if you take the volatility of hour by hour, it looks like it's highly volatile, but if you average over the day, it's much less. If you average over the month, the volatility goes down. And when you have mean reversion, when things cycle, go in natural cycles, the volatility will be much less when you compute volatility over long-term averages rather than short-term averages. Now, if you have stock prices or random walk things, that effect doesn't occur because they don't move in cycles. And we can use volatility for different time periods to judge whether these things are really moving in cycles, i.e. whether they have mean reversion. Now, that's really exciting, but I'm sure not many people will be all that excited about this, but I am. So, back to our read stocks file. And now we're going to kind of go through some of this statistical analysis. Here's our scatter plot. And here it is. Now, as you recall, maybe not. Okay? What I did was first got kind of a base stock. And that works with this indirect, this lookup and indirect. That's the stock we pick, okay? And that just comes from the sheet. And then I get the percent change in that stock by taking a natural log of this period divided by last period. That's a continual rate of change. If you kind of want to figure out what the a discrete rate of changes, you just take the last period divided by this period minus 1. This period divided by the last period. And then, depending on when this little switch changes from true to false, from false to true, excuse me, okay, then I just start computing the index. And this says an if statement. Well, if this is true, then take the last index times 1 plus the growth rate. Otherwise, just leave it as 1. So that's how mechanically you make a flexible index. Okay. No. I was going to open generic macros and color all the falses and all that. So that's what I did here. Okay. Now in this case, we still have Chesapeake versus the oil price. Okay, and maybe to show you how this works a little bit, let's go to 2002. I hope it had some history back in 2002, and it did. It did, and the relationship changed a little bit when we changed the time period. Shouldn't really happen if these things are stable, but they never really are. So, the first thing we could do is just make a standard regression. And we can just take the slope of the stock versus the index. Now, don't worry about this just for 1 second. That's the R squared and the intercept. So if we go down to 2002, we should start getting data. And this data says, okay, let's make this 6 as a function of this. And this equation says take the oil price times 0.2 and add an intercept of 3.76. And then you get an equation. Now, given the fact that the oil price went from 20, is that right? Was it really 20 in 2002? I guess it was. And then in 2003, it was going up to 30, and then it went to 50, and then we get to 2008, and it should have gone up to, into the hundreds. Okay, can we really just take a flat 3.76, add 0.24, and get the stock price? This says when you do that, you get an R squared, which is the percentage of variation, not variance, not standard deviation. So there's some square problems here. How much of the variation in the stock price is explained by the variation? Sorry about this. You kind of have to calculate things, I guess, when you do that. All right, and so 2008, the stock price, the oil price should have been going up. It was going up to 100, and people said it could never get to 100, and then they said it was going to get to 200, and then it started falling. And by the time the financial crisis hit, it was way down. And the stock price went down too. So the correlation says there's a 67% correlation, movement, relationship between the stock price and the oil price. Now here's one issue. I used a dynamic range name that changes depending on when this true-false thing changes. Now to do that, I said, well, let's put this one. Let's just match the true. In the very first column, which goes from column 12 to 4,000, let's find the first true. That's the starting point. And the length is, just count how many trues there are. That's pretty tricky. And then we use these as parameters in the offset function, which asks for the first row, the first column, the length, and the width. Those are the only two things we need, but we can just use those true falses to kind of get our parameters, and then we press Control F3, and you look at the stock base here, and you click on this little thing down below here, and it says, well, that's where it starts. It starts in this row. I think I was off by 1 row. Sorry, don't tell anybody, as if that makes any difference. And then it should go down all the way, kind of to the end. And we use those range names that change depending on, oh, look at that. Look at that. I need to subtract 1 from this length here. And I guess I have to subtract even 1 from this one. Well, I just overdid it. I should just subtract 1 from this one, shouldn't I? Okay, and I'm sure that made an enormous difference, but we fixed it in all of them. All right, now let me just digress for a minute on this true-false business. Now in this, I'm just pressing Control-Tab and not getting anywhere. In this kind of little summary sheet, I made a little X and Y. I said, well, the Y is the dependent variable and the X is the independent variable. And we're going to make a little regression analysis. And in our regression analysis, we just take the intercept and we put the Y's in first and then the X's. And then we go to the slope and do the same thing, the Y's first and then the X's. And then the R squared, the Y's and the X's, and we get kind of our 3 parameters. I don't know if you need much more. Now, in this case, I did the same thing, but I said, okay, let's make a little counter here. Alt-EIS, enter, of course. And I said, well, if the kind of classic with the true-false, when this number is less than our kind of number up here, let's make it true. And then over here, I said, well, if it's true, then just put the number in. Otherwise, don't do anything. And if you don't do anything, guess what it does? It puts it as false. So if we make it 4, it just makes it a thing of 4, and it gave us a different slope. And clearly, it changed this. Now, the question is, if I put equal intercept here and just only select this one and only select this one, then it gave the same thing, and slope the same thing. Now, if you have these kind of issues, I did it first with some big database, and I probably put that little 1 and -1 made it look like it was a little different. The true-false works. Now, with the offset function, I made an X and a Y. So on this one, I press Control F3, and on the X, we have an offset, and it starts at the top, moves at 0 rows, 0 columns, but this is J4, so this is the length. So Y, X, and Y both have a length of 4. Now when you do that, you get the same number, and if we put 3, okay, so that's that's supposed to happen if I put 5, all right, then it gives you exactly the same result. So, to be a little lazier, it would have been probably better to simply use the true and the false in the analysis. But I made a range name, okay? We'll see in a minute. Now, here is the thing. If you have time series data, remember how the oil price gradually goes up and down? And of course, when it's higher, there's going to be a kind of higher stock price, but what you want is to see, okay, we're at some point in our history or in the future, we're at some point in time, and at that point in time, I want to understand what's going to happen to the oil price and the stock price. Now, if it's a higher stock price, of course a higher oil price, of course we're going to have a higher stock price, but that's not really information. And what happens here is when you compute, let's compute first the predicted value. The predicted value just says take this switch, whether it's true or false, and take the intercept and add the slope and multiply it times the independent variable. There you get a predicted value. The residual then is just the actual value minus the predicted value. And then we can kind of adjust this and only take the residual value for the prior year, really. Then we can go back one and take the residual value in the prior year. And we can make a regression that says, let's take this residual. And here the oil price was low, so the residual was low. But then we go, and if we take our standard regression, as the oil price, I have to go a lot further here, as the oil price, we have a negative residual, and keep going, come on, come on. Here, when the oil price is getting higher, we have all these negative residuals. So, this residual depends on what happened in the last period. If we have a last period, it's just going smoothly. And these residuals are in no way, shape, or form independent, which is one of these kind of assumptions to get an unbiased regression. These residuals are supposed to be, they're blue. I remember that from 70s. Oh, God. Best linear unbiased, something like that. So they're clearly not independent because we get a 99% correlation. Now, and you could have done this, so you see this is the residual base against the residual lag. Now you could transform the data. And when you transform the data, you say, well, this is, just a minute, the transformed data says, well, take the stock, take the last period and multiply it by this estimate of autocorrelation, and compare that to the current price. So that's almost like a change in the price. And then if it was 1, it would just be the change. It would be just this period minus that period. So we make it by 0.99. It's kind of almost the same. And then you get a completely different slope. Then you say, well, the relationship between the change in the oil price and the change in the stock price is 15% instead of this 24%. And really, we only have a correlation of 32%. Now, whenever you work with stock prices or oil prices or commodity prices or indexes, I think you really should take the percent change instead of the absolute change, and you just transform these to logs. And then the slope here then gives you a kind of elasticity. What's the percent change in the price? The stock price when divided by the percent change in the oil price. That's the log. I'm not going to prove that to you because I'm not good enough to do it really anymore. All right, and so we first transform these things to logs, and we say, well, we better be careful because if there's a negative number or 0, it doesn't work. So I just put in a false if there is. So we transform these to the logs, and then this is the regression when we transform these to logs. Let me see now. So this is in terms of an elasticity. We get about a 1-to-1. Okay, and then, but we're not finished. When you transform them to log, you do exactly the same. You compute the residual, which is the predicted value versus the actual value. And then you compute the lag of that residual. You just take the last period. I hope I did that okay. This was the residual. All right. This was the intercept plus the slope times the number. It's not all that complicated, is it? And then you transpose these, which is taking the current number minus the last number times this autocorrelation. And you do that both on the independent variable and the dependent variable. And that's how you make your you get your transformed regression, and now we have this slope of 0.48. Look at all these different numbers we have. All these different numbers. Which is the right one? Well, I think this one is. And then, if you would just do it, what's so interesting to me, I didn't know this, if you just take the log of this period divided by last period, and you do another log of this period divided by last period, and you do a regression of this one, I just call this the stock and the index, you get, look at this, it's just about exactly the same number. That's because we have almost, here, almost a 1-to-1. It's almost perfectly autocorrelated. That could be negative if there's negative correlation. And then finally, you take this is just the standard deviation. Now, when you compute volatility, you take the number of time periods it takes to make up a year, because volatility is on an annual basis. And then, for some reason, I think you can kind of demonstrate this, because it's a standard deviation, not a variance. You take it to the half, you take the square root. So the volatility of the change in the price of the stock is 54%, the oil price is 34%, and the residual, after you have taken everything out, that is 17%. So those are the statistics. And let's kind of finish this off by looking at some of the statistics, which I've already kind of shown you. We'll stop here. Now, if I would put this instead of daily, monthly, here's kind of an interesting thing. The beta, you get a different measurement of the beta. Now, you get a slightly different autocorrelation in 64. It still gives you about the same number. I should be better explaining. I believe the right number is to take the finer data. Okay, I'm just saying that. Now, the volatility in the price of oil, let's look at that one. If we take it on a day-by-day basis, 34%. If we take the volatility on a month-by-month basis, it's still about 40%. But look at the stock price. The volatility on a day-by-day basis is 54%. And if we make the volatility on a month-by-month basis, it goes down to 47%. And the most interesting thing of all, perhaps, is this residual thing. It's 17% left over. That's really maybe our most pertinent measure of risk. That's like this famous arbitrage pricing model that when I read about it was a confusing bunch of mishmash. Now it's not, because you can hedge out the price of oil, because you can go to the futures market and hedge it out. And then this might be a much better measure of risk, because it shows you what's left over. Maybe you have to do a little bit fancier. Is the beta against the oil price the measure of risk? The beta against the index and systematic risk, that's the better measure of risk? What's the real right measure of risk? Now, here, let's, instead of putting the oil price in, we just take that, and now we're just looking at the index. Now the beta here is 1.39 on a daily basis. On a monthly basis, the beta changes. And this is kind of interesting. The autocorrelation changed. Should you reflect this fact that we did? It's not a perfect random walk. So you could argue that this is kind of a better measure of the monthly beta than this. I don't want to get into that too much. Okay. Now, if you look at the volatility of the U.S. stocks, it's 0.14 on a monthly basis and 0.19 on a. So there is a little bit of mean reversion even in stock prices, which says the market is not perfectly efficient, which says it cycles instead of just gradually moves around. Now, I don't know if you let's take kind of a shorter period. Perhaps that's just too long a period. And then we have the volatility from 2013 only of 0.09 on a monthly basis, and 0.12. It still has some cyclicality. It still has a little bit of cyclicality here. The beta changed a lot, showing you that the beta is not very stable. If we look at somebody more like Shell Oil, there we get a beta of just about 1. If we do it daily, if we do it monthly, we still get a beta of just about 1. If we go back to 2001, it doesn't work. 2002. How about 2003 to make sure? And then, ooh, the beta did change this time. Let's put it back to daily. And, oh no, we still get our beta of 1. Okay. And we can look at the volatilities and all of that. Now, one more thing before I finish. If I want to see, well, how much does it react to the gold price? Well, that's going to be pretty silly. The beta is almost 0. I don't really care about that. I want to look at how the gas price. And the beta against the gas price is nothing. Maybe we had this extreme spike. I think this was a Hurricane Katrina, if you remember this. Okay, and now let's go back, perhaps, to our Chesapeake. Now, a couple things about gas. This has got a much higher volatility than oil. For me, that's well known. Okay, the beta, it doesn't, even though this is a big shale gas producer, in fact, this Range Resources seems to be mainly shale gas. Look at this. The beta of gas is not very good compared to the beta of the oil. All right. Oh, no. This is just a little thing that there's a missing value in the price of oil. I said that quickly, okay? Now, if I'm going to look at gas again, okay, and, shoot, this stupid thing on the very first number, see, if we take we put a raw number instead of the index, and this is, I don't want to show the index, because the stock index, because that's distorting kind of the graph. You see these little zeros in the raw index. I didn't make an adjustment for those. I'm just explaining what happened here. So instead of the raw number, let's put the index number, and I'm looking at the volatilities. The volatilities, well, they're not supposed to really change. And let's go back to Chesapeake. No, let's leave it Range Resources. The reason this is the gas price, let's go to 2005. I'm sorry, I'm going back and forth like this. Okay, this is what happened with this famous shale gas. What's so interesting here is that as the gas price came down, first of all, we have a higher volatility, and then if you look at this 64% volatility. But then if you do it on a monthly basis, the volatility goes to 54%. So that suggests there's some mean reversion, not that much perhaps. And now let's kind of move the gas price and move down to 2010 after we kind of have it. Now there seems to be a more relationship, although this beta isn't really showing one, and we have a 57% volatility on a daily basis and a 41% volatility on a monthly basis, showing some mean reversion. And this is our gas price versus our stock index, and I am just about finished. Whoops, I better put some thing in here, so I'm going to put our stock index, and we can kind of see this is range resource, so this is a beta of 1.1, and it's just a scatter plot. Now, if you did this scatter plot with true false, that doesn't work. A scatter plot, you really have to use the range name if you have some true and falses. Sorry about that. Now, if we go, I'm not sorry about it. Why should I apologize for that? Then you can see that, well, this is Shell Oil. It just has a higher R squared. It's just more related to the market, even though the beta is less. All right, so that's what you can do. Now, if you tried to do this in Power BI, I don't think you could, and I don't think this kind of little, maybe you'd like a better dashboard. I can't figure out how to really make it, but I think with the little drop-down boxes and all that, it's okay. And that's enough.